Good afternoon, and welcome to Pincus Co. Live, the weekly New York City commercial real estate broadcast. Thank you for joining us for our 6th episode. Prior episodes are on our YouTube channel and via podcast. Today, we're focused on stalled development sites in New York City. How do you identify them? How do you engage with the parties? And what are some of the possible outcomes? We're broadly defining stalled as any site with DOB plans filed in 2017 or earlier that has not been permitted or where construction has halted. Both our guests are brokers with deep experience in brokering stalled development sites. Eric Anton has more than 25 years of experience in commercial real estate. His group at Marcus & Millichap is focused on investment sales and equity placement transactions in the New York metro area. Anton has brokered many land sales and recently completed the $650 million recap of the stalled DEF site at 520 Fifth Avenue in the core of the Grand Central submarket. Our second guest is Ethan Stanton, a managing director at JLL, where he is part of a team that focuses on investment sales also in the New York metro area. Ethan has completed more than 300 transactions for an aggregate consideration of $3.5 billion. A good chunk of his business is in development sites. 3 recent deals were for stalled development sites, all in Brooklyn, one at 1 Java, one at 555 Broadway, and another at 1215 Fulton. I'm Adam Pincus, founder of the 3-year-old media and data publishing company Pincus Co. Media. We publish newsletters on transactions and new development, which are populated using our proprietary data. We don't want to inundate our listeners with a hand laundry list of stalled projects, so we're going to mention a few as we go along. I'd like to start that a stalled site can be owned by a well-capitalized developer or a developer sorely in need of money. An example of a developer with plenty of capital is the Durst organization. Their project at 1800 Park Avenue in East Harlem, where Bruce Eichner originally filed plans in 2013 for 607 units, has still not gotten underway. And the Durst organization filed a lawsuit against the MTA trying to get things going, alleging that they are dragging their feet. But then there's other examples like Brooklyn Capital. There's a 227 Clarkson that's headed to foreclosure auction, and another Brooklyn deal project at 154 Lenox, where the new operators of that company are put into bankruptcy. Another is the Collective, a co-living group that recently sold a couple of projects. This were 555 Broadway and 1215 Fulton that Ethan worked on. So Ethan, you worked on this. You want to talk a minute about what those deals were like and how you got them?
Yeah, sure. Adam, thank you for having me, and Eric. It's nice to be on the stage with you and to talk shop. So 555 Broadway is a site that our group is very familiar with. This most recent transaction is actually the 4th time we've brokered this deal. We sold it to the Collective in 2018. They had plans for a very ambitious co-living project with a hospitality component. And when they were moving along in the pre-development stage, they ran into issues getting equity and debt for the project, especially because of the pandemic. So you had a site that was totally approved from a DOB perspective. You could dig a pile in the ground the day after you closed on it or at any point when they wanted to, but they were having a hard time raising money for the deal in its current form. And because we've worked on the site historically, we knew that there was an underlying residential zoning of that site that had 250,000 feet of residential, totally fine as of right. You didn't have to do a hospitality. You could do it in an 8-story building. You didn't have to do it in a 20-story tower. So because 421A is going away, Eric could agree to this, but we're getting calls 10, 15, 20 times a day from developers in the city looking for sites to vest 421A. This to us was a very clear site that had the ability and a clear pathway to vest the 421A. So a competitor of ours was running a UCC auction on behalf of the lender on 555 Broadway. We knew that that was in the mix and being shopped around, but there was like an aha moment or an epiphany when we were just scratching our head a bit and saying, why would someone buy the note here to then go through and do a foreclosure when someone could just approach the collective and see if they can work out a deal with them and pay off the existing lender. So that's exactly what we did. We went to the collective with a very active Brooklyn developer, and we approached them and we basically said, like, you're not really going to get any of your equity recouped here, but we can get you out. We can get you off the guarantees. And the lender was also totally willing to play ball because it was their best outcome for them. So we brought a group to the table. They closed for $54 million. It was a 30-day TOE closing. Again, they had urgency to vest the 421A. And we were able to basically rinse and repeat and do the exact same deal at 1215 Fulton with different developers, which is also a collective project.
How do you convince them that it's time to let go? Like, do they see comps and like, we're not going to get more, this is the time, or we shouldn't go through
look, when you're selling these sites, you know, it's great that for the broker, you have some glory. You did a $54 million deal. You followed it up with a $33 million deal. But these transactions aren't fun, right? There's no closing dinner after these transactions. This is a transaction where sponsors, developers, your clients really are in a position where they're losing a lot of money that is their own money, but also their investors' money. So you need to be very delicate with it. But we knew with our relationship with the collective, because we brokered these deals to them, that they were going to basically give back the keys and do a workout with the lender. And when we approached them, we basically said, instead of giving the keys back to the lender, if we can get you a couple of bucks on the side and we could pay off the lender, isn't that the best outcome? And then you're off the guarantees. And they agreed. So they already had thrown in the white towel. And that's an example of when they already threw in the white towel. We were just able to catch it at the exact right time, where we were able to kind of, go over the UCC foreclosure, deliver a developer a fee interest in a property.
And Eric, you've got the project on Fifth Avenue that was not moving ahead at sort of the original plan. What did you do there? Like, how did they handle that?
Yeah, that was an interesting deal. Just to take a step back, I'd agree with Ethan that the 421A it really is critical to the city. And it's unfortunate the politicians couldn't get together and extend or, come up with a modified version. I think that's going to be a very big negative for multifamily development here in the city. And as we saw in 2015, it took another year and a half before the cooler heads prevailed and we got a good program. So I also agree that it's not always fun to do these distressed deals. It's fun to get commissions. It's fun to successfully do a transaction, but I always say it's better to do, business in a rising market where everybody's kind of optimistic. The 520 Fifth Avenue was very interesting for me. Way back, we in a previous role, we sold it from Joe Sitt to the Ceruzzi Equities Group. Ceruzzi actually went back and forth on different plans for the site, which is located on the corner of 43rd Street and Fifth Avenue. They were planning originally on doing a big retail component and then a hotel component in the middle of the building and then residential condos up top. And that plan changed many times. And unfortunately, the principal at Ceruzzi passed away in, I'm guessing it was 17, maybe late 17, early 18. And that kind of threw the project into disarray. The condo market, if you remember at that moment, was kind of shaky. There was a lot of product, a lot of very large units were hitting the market. And originally this project was planned to deliver big, fancy, expensive units for the Chinese and Russian billionaire community. And that evaporated in late, 18, 19. And so it took a lot of work to try and get to the decision makers and get the lenders comfortable. We ended up never getting the lenders comfortable. And, thank God we closed sort of minutes before there was a bad situation for the borrowers. But we were able to bring in a new developer who radically changed the plan. The hotel went out the window, and the new plan was to sort of draft off the success of One Vanderbilt office building leasing and create a boutique style office building in the base of the building, minimize the retail to just two levels plus basement, and keep the units, keep the residential component up top, but to radically reduce the size of the units. So increase the number of units and really make it more like a pied-à-terre. So fast forward, we sold that a couple of years ago. And now just several weeks ago, I think the construction financing came into place. And that project looks like it's going to get built. And so that's great when you sell a project to actually see it, underway. They're digging the hole right now. So that was a really interesting deal. We sold the land for $225 million. Part of the story was traveling to Shanghai twice to get the Chinese investment group to be comfortable with what we were up to. So that was it was interesting and fun, had a global aspect to it. So that was that story.
So tying it, like how, in general, like how do you identify a deal and then go after it? Like how do you find stalled sites, and then how do you find an opportunity to kind of get in there and make a deal happen?
I think, nowadays with technology, it's incredible the research you can do in the palm of your hand. But my guiding light is always kind of like a funny feeling in my stomach when I'm driving around the city or I'm walking across the avenue and I see a site. Then a couple months later, I see the site and there's like nothing going on. Just like alarm bells go off, So, being aware of what's happening, being aware of the leasing activity, being aware of the general market, the interest rate environment, and just feeling, which sites might be in trouble.
But aren't there like 100 other brokers doing the same thing? Like how do you get their attention? How do you kind of break through?
It really comes down to just old fashioned being creative, hard work, and personality, trying to make friends with the developer, make them understand that you're trying to help them. Developers want to develop. So no matter what the market, their job is to build. And if banks or investors give them money, they're going to go build. But sometimes it doesn't work out. And sometimes lenders are, going to be aggressive and try and foreclose. Investors are going to sue, et cetera. And so, timing is everything. As Ethan said, he was in the right moment. He had 3 great ideas and he was able to execute. And so it's really no different on any site. The more complicated the site, the more challenges the site has. That's when you have to really understand what's going on. It's not just like, hey, I have a guy. 100 brokers can say I have a buyer, but do they really have a buyer? Probably not. Do they really understand all the issues, the construction complexity, the partnership matters, et cetera, et cetera. So it's a lot of hard work. It's a lot of just doing the research, doing your homework, and I can't minimize the luck factor, being at the right moment at the right time.
Yeah, I would definitely echo the luck factor, but the luck factor has to be, with just staying obviously on top of your clients, and especially this is a deal that I had previously brokered. This is a deal that Eric had previously brokered. So there seems to be a common theme there for brokers. If you broker a development transaction, you should be following that site along. You're obviously hoping for it to be a successful project, but when you hit something like a pandemic and when you hit something like high interest rate environment, you need to be talking to your clients to see if there's a potential solution. And a potential solution doesn't have to be a sale of a stalled site, right? You could theoretically offer to bring in new, fresh, pref equity. Maybe you're trying to replace their construction loan with a bridge loan to get them through. So as long as you're constantly on top of these clients that are yours, that are these development clients, and talking about possible capital market transactions, you'll be there at the right time in the event that something goes south and there is a stalled development site to sell.
Do they look at that as you're like criticizing, like it's not going well and like don't call me anymore, and or do they take it like, oh yeah, I need help? And
I think that there's a little bit of an art to that conversation and to that dialogue, and it's very honest. You're not hoping for this to be an outcome, right? Like it would be a much better outcome if the collective finished 555 Broadway and then said, Ethan, you sold me a great project. Go sell this for $600 million, and to some South Saudi like exit. So that would be a great outcome, and I think that they're aware of that, and that's what we're all hoping for. But I think you can have honest conversations with them, saying, how much time do you have left on your construction loan? Do you have an extension? Just really understanding the capital stack is important, and then who you should be talking to within that capital stack, right? So there's stalled development sites. There's no reason really to talk to a developer on certain stalled development sites. You should just be talking to the lender. You shouldn't be talking to the senior lender. Maybe you should be talking to the mezz lender. So I think it's really important to look at a piece of real estate, come up with what your opinion is of what the value is of that real estate to the best that you actually can. And then I think you need to make and point yourself in the direction of who you're going to have that conversation with.
Eric, like, what if you're not, you or Ethan in these deals? Like, how do you get in another deal? Because there's always, the person who sold that site.
If you're not Ethan or myself, you should just move to Miami, and everything's good in Miami.
How do you, like, if like you
No,
already
I
have
think,
this thing?
listen, it's New York, right? There's a couple things just popped into my head. So this is New York. It's the most dynamic, still the most dynamic, active market in the world. And, some situations can't be resolved. Sometimes developers do lose properties to the lender. And so I part of what I teach the younger guys on my team is not to waste time on situations that can't be resolved, right? There's certain development projects, or, we sell office buildings as well, that are going to go back to the lender, and there's no role for us. So we don't waste time on, on working on transactions that can't be executed. So it's a little bit of, understanding, how to allocate your time. That's important in New York. And also, because we live in this great capitalist society, and because you're allowed to fail in America, and hopefully that will remain, developers might have a terrible project that's completely underwater, that's, financially obsolete. And 2 blocks away, they may have a great project where they're going to make a ton of money. I think you mentioned in the beginning, Brookfield gave back a big office building, and Blackstone is giving back a big office building. Lenders aren't going to look at Blackstone and Brookfield and say, oh, they gave back an office building, I'll never lend to them again. It's just part of America is creative destruction. Those didn't work out. The tenants left for whatever reason. They couldn't release in time, the pandemic, et cetera. And so if you're an honorable developer, if you have a good track record, and if you don't go to war with your lenders and investors, most likely you'll live to see another day. Conversely, if you're not honest, if you're not forthright, and if you pull a lot of shenanigans, then you could be, sort of blackballed in the community. That, we've seen that too. So I think it's, it's a matter of, again, putting in the effort to understanding the deal. And if the deal is just not going to make sense, then you move on to a deal that does make sense.
There are a couple sites that have come on, and the one is, I hate to say rumored, but it supposedly has sold. The CBRE was marketing the Toyoko Inn site. They were planning to develop a gigantic hotel there. Another one of these stalled development sites, or it is Silverstein's got something on West 41st Street. Silverstein is obviously well capitalized, so it's one of those interesting cases. What's going on there? BD Hotels, who's of course has their hands full with the Chelsea Hotel, which is just reopened, but they've got this plan. They were on 6th Avenue. So there's a lot of people who, oh no, sorry, there was on 42nd Street. And then Fortuna has something on 6th Avenue. So like when you guys are like looking at all these stalled sites, how do you decide which one to go after?
Yeah, I think you need to have conversations with all of them, right? So there's definitely, something to be said about sites that were historically planned for hotel. There's going to continue to be a good amount of distress in the hotel space in New York City for quite some time. And a lot of these sites have other applicable zonings where you can build an underlying residential. So 2 or 3 of the sites that you just mentioned were all hotel sites. And I think if you look at those sites and you acknowledge that there could be an amendment to the current plans that theoretically could vest under a 421A, or something on the west side has a booming condo market right now and the fundamentals are really strong, that's something to bring to that developer to say, here's why I think it is the right time. Here's the sellout of the building across the street. I know you had a vision of doing a hotel. Your bread and butter is in condos. Why don't we run a process and see if we can get you out of this to a condo developer?
Another issue.
Yeah, I would agree with that. And I remember one or two of the most successful brokerage, transactions I pulled off were convincing a developer that the market was not right for his use, but he could sell at a profit to an alternate use. So I agree with that 100%. Knowing the timing of that that's the art. And somehow convincing a developer not to execute a plan that he's put perhaps years and millions of dollars into because there's a better plan. That's kind of the epitome of brokerage.
That's exactly right. Having a spec office site and going to a developer who's extremely well qualified and saying you're going to sell it again as a spec office site to one of their competitors or one of their peers is a tougher pill to swallow. And sometimes it happens. Sometimes there's partnership disputes. Sometimes there's a maturing debt. Sometimes someone has a new bucket of capital and can build off of that. But what we see happen and kind of the transactions that are the path of least resistance are those that have a change in use and a change in the plan.
I was wondering, as you guys are approaching kind of recap or sales or something, the difference between just dirt and then a partially built building.
So again, my thought on it there is that it really depends on the capital stack. And I can't emphasize that enough. And I know Eric will agree. But if you have a building that's 80% complete and the building needs $10 million to finish it, but then theoretically there's profit and there's opportunity above that, you want to be talking to the developer because there's ways to structure a deal where it's just a traditional pref equity deal. A new co-GP comes in, they share profits, it's on a waterfall. There's a million different ways to structure, but there's also deals that are 80% built that no amount of money will get and pay off the existing debt, at which point you should be talking to the lender.
Mm-hmm.
That's right. That's right. 100% right.
And do you approach attorneys? Do you approach?
I think
anybody with a phone, anybody with a phone, I'll call. But if attorneys, architects, GCs, expediters, I mean, we're in the weeds with everybody that's within these projects, within these deals. Obviously speaking to the decision maker is the most important. So being able to call the decision maker and the appropriate decision maker, whoever we think is going to make that decision for that project in that capital stack with something that's relevant, not saying to Eric's point before, I have a buyer, right? Everyone has a buyer. There's hundreds of buyers, there's thousands of buyers, but bringing a valuable piece of information that hasn't been posted in a publication that isn't public knowledge of, hey, this deal's about to go off across the street from you. This is where it's going to trade. Why don't we look at your site? That is who you want to be talking to. You want to be talking to the decision maker, but you also want to get insights from everybody on the ground.
I think that's right. And I think what we're going to see over the next 3 to 6 months as interest rates really start to rise and have risen rapidly, very rapidly, I think this is going to light a fire under a lot of the lenders, and it's going to restrict their ability to kick the can down the road. So I think there'll be less kicking of the can and more kicking of the borrower.
Meaning they'll foreclose, or they'll just try to.
They're going to
more money.
You can't, if your costs of borrowing and your opportunity costs are large enough, then you're going to be much more aggressive to try and either work out something quickly with a developer or foreclose or sell the note. We have a great team here that sells notes, and that business is picking up. We just sold a future development site on 28th Street a couple of weeks ago, 2 weeks ago. And so I think things are starting to pick up.
Yeah, I think that's right. I think, the pandemic was an interesting time because we lived in a period, especially for the first year of the pandemic, where people thought that we would get vaccinated and the pandemic would be behind us. So the lender's instinct in that regard was, let me give my sponsor forbearance and we'll kick the can, to Eric's point, right? That forbearance has been given now for 2-3 years. And if you have a vacant office building and you don't really have any tenants in sight, and your basis is accrued to a point that is just so high that the market rents aren't going to sustain it, I think you'll see a lot of these lenders start to pull the trigger and sell notes.
That's
How
right.
big is the universe out there for the note sales and for stalled site sales? Like, do you think we'll see 100 above, a 10,000 feet buildable over the next year, or?
There is no lack of liquidity in the market. We're going up against, obviously, tremendous headwinds right now on interest rates. So pricing needs to come in, and will continue to come in. As interest rates continue to rise, you can't manufacture the returns that you could 90 days ago. But there's no lack of liquidity, and there's no lack of people willing to deploy capital. It's just, we're starting to find a world, and we're entering a new world where things just really need to start to make sense.
Any
I think
idea
that's
though,
right. And yeah,
of
just
volume?
adding on to, in terms of volume, I think
Yeah.
you threw out a number of 100. I wouldn't be surprised if that wasn't a very accurate number for a 2-year period of, call it 30,000 square foot development sites and up in the 5 boroughs to hit the market, to retrade, to trade, or to be recapitalized. That might even be low, frankly. And I think also in terms of the interest rates, not only do you have interest rates rising, you have this inflation, and I'm sure we're going to see rapidly increasing construction costs. Not to mention the fact that the government trend now is more regulation, more higher costs for construction. So all those factors probably will convince lenders, I can't just hold this forever. I got to sell.
Which way do those pressures, like, what's the impact on the buyer, that they will try to trade it, they'll sell it themselves, or it'll go into a note sale?
You mean the lender?
Will buyers just want to sell the property before it gets to a note sale? Like, is that?
I think, as I said, New York's the biggest, most dynamic market. There's an infinite number of ways that this can happen. So you're going to see some lenders sell notes. You're going to see some lenders foreclose, take back the property, maybe even some debt funds that execute on the plan once they get title. So you'll see a little bit of everything. But I think the traditional lenders will probably move towards selling notes more aggressively than last year.
And one of the things, just in terms of like the market, the bucket of the well-financed versus the not well capitalized, is there any way, when you look at the market, how many are what kind or another?
It's hard to break it out into, who's well capitalized or who's not. But like, if you look at a project, we were a part of, we sold the River Ring site to Two Trees in Williamsburg, and they bought Domino, dating back 7 or 8 years. If you looked at that over a computer, you could say, is a part of Domino a stalled development site, right? There's certain buildings that have had permits that they haven't. They're being strategic about bringing product online and not cannibalizing what they've created there as they create a community. So if you look at some development sites and you see the Durst organization, or if you see Silverstein, they're okay waiting. They're going to wait for a better market for them to build an asset that works for them under a business plan that they think they have, or whether there's going to be a new business plan in the future. So Eric hit the nail on the head. You just need to be careful about where you spend time or where you don't spend time. You can't get so hung up on saying Silverstein pulled permits on a site 5 years ago. They're going to lose this one, right? You need to kind of take a step back and say, what's really happening here. And I think that it's hard to break up, like I said, just who's financed and who's not financed, but there's many different buildings going vertical, and you should be talking to the right person in all of those deals at all times.
Yeah, and I think, having lived through a bunch of these cycles, what's interesting is the super well capitalized often don't come back into the market after the dip. And what happens is, groups that are not well capitalized have the energy and they're younger and they have new vision, new ideas, and they'll team up with new sources of capital, whether it's foreign money or whether it's institutions or high net worth office, family offices. So I think we're about to see the beginning of that. We're going to see many, many new groups coming into the city, and they're going to be pulling off deals. And we'll read in the paper and on the Pincus report, wow, who is this guy? He pulled off a $200 million deal. Amazing. That's coming. That's coming.
Well, we'll want to read about that. It's actually interesting. I want to keep reporting on these new players who come in here. But I'd like to thank you both. Thanks for participating. I want to thank everyone for watching. And this will be converted into a YouTube tomorrow, and then we'll put it on our podcast, and you can watch it then. Okay. Well, thanks so much, and have a good day.
Thank you, Adam. It was a pleasure. Thanks, Eric.
Thanks, Adam. Thanks, Ethan.